Good morning. This is Larry McMillan with the stock market update on Monday, November 30th before the market opens. Well, S&P is bumping up against the all-time highs actually on three different days now, the first being November 9th and then a couple of times last week. We've tried to get through that 3644 area and have not been able to, but I'm pretty sure it's going to be able to do that fairly soon. All the indicators are fairly positive, and we're entering a positive seasonal period between Thanksgiving and the beginning of the new year. Most years it's positive. 2018, of course, it was not. The S&P chart has support below here at several areas. If it were to close below 3,500, though, that would be negative. In my opinion, that would put it back in the old trading range. So that would be the negative stop out if you're looking for one. Put call ratios continue to plunge. Put call buying has been just unbelievably strong. And most days now, the CBOE equity only put call ratio is in the 40s, sometimes even in the 30s. Our own stocks only equity only put call ratio is also in the 40s. And at 50, that means twice as many calls are trading as puts. So in the 40s is even more than that. There's just a wild speculative fever going on right now. And while it might be making the market overbought, remember, overbought does not mean sell. Breadth has been very positive. The breadth oscillators are on buy signals. And while they're in modestly overbought territory, that's actually a good thing when the market's breaking out to new highs, as it almost is. And also, cumulative breadth is making new all-time highs. And then on Friday, cumulative volume breadth also made a new all-time high as well. So those are all positive signs along those fronts. New highs continue to dominate new lows. In fact, new lows are almost non-existent. Again, on Friday, there was just one new low on the New York Stock Exchange. And then there's volatility. So VIX closed at its lowest level on Friday. It's the lowest level since February. And it continues to be in a downtrend. And those are bullish things for stocks as well. If it were to rise above its 200-day moving average, that would be negative. But that's getting farther and farther away now. That moving average is still rising slightly. We also have the construct of volatility derivatives. It's in a pretty positive state, not 100% positive, but now the term structure slopes upwards through December, January, February, and then flattens out after that. So what that really means is that buyers of S&P SPX options are still paying up pretty much for them out into next year. So there are some worries about what might happen next year. We know in the past that these strong Decembers sometimes roll over into pretty strong Februarys, and then real trouble starts after that. 2018 and 2020, of course, being the two main recent ones of that ilk. So we are suggesting that traders roll positions up, tighten stops, but you still have to be long in this market as long as the momentum and the indicators are saying so. We have a Saturday webinar coming up a week from Saturday on December 12th. We're going to be just kind of wrapping up the entire series and talking about some other subjects that we haven't been able to get into all the other webinars that we've had along the way in this regard. Also, I invite you to check out our newsletters. We have a couple of new ones, the Daily Put Rider and the Special Situation Alert. Also to go along with our stable of strongly performing newsletters such as Daily Volume Alerts and the Option Strategist and the Daily Strategist. So thanks for listening and have a great week trading.